The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. Crude prices in a holding pattern after falling below pre-Iran war levels last week, as OPEC Plus countries agreed to boost production. But the ECB's Gabriel Makhlouf tells CNBC that won't be necessarily translating into immediate inflation relief.
We know inflation is already in the system, and the fact that oil prices have fallen doesn't mean that inflation is going to disappear. So we need to continue to keep a very close eye on what's happening.
From Chinese competition to US tariffs, EU Industry Commissioner Stéphane Séjourné tells CNBC the bloc must defend its strategic interests in the face of mounting geopolitical challenges.
We have sectors facing unfair competition, and we're dealing with American tariffs, which we didn't want. Each sought to defend their own economy by re-industrializing. Europe's re-industrialization will also depend on defending its economy with strategic sectors.
EasyJet reaches an agreement in principle with Castlelake, the US investment firm due to acquire the budget carrier in a deal valuing it at up to £5.5 billion. And a red card controversy. US President Donald Trump personally thanks FIFA for lifting US striker following Balogun's red card ban, prompting anger from Europe's federation. Meanwhile, England and Norway fans rejoice following their country's World Cup heroics.
Welcome to another big trading week, and we kick off the start of trade on Monday with another big deal in the media sector. Consolidation is the name of the game in the content world, and the latest is that ITV has agreed to sell media and entertainment business to Sky for up to £1.6 billion. So first up out of the gates, this deal rolling across the wires, £1.2 billion initial cash consideration payable at completion. Plans cash return to shareholders of around £950 million. That's 25p per share. Contingent cash consideration of up to £200 million payable in the second half of 2028. The deal expected to complete by the second half of next year. So still some way to tread in terms of completion here. The latest Sky to pay £80 million break fee if the regulatory conditions are not satisfied. So it's quite a significant fee there if things do not progress. And 11.5 million break fee is to be paid if Love Productions acquisition not approved. So clearly some regulatory hurdles seen at various different pieces here. And there's no doubt consolidation is happening. We're seeing it through the lens in the United States. Major studios, major interests that have been consolidated, but also demerged. If you look at our very own network, the big demerger that took place. So I think there's a real revaluation of assets. And if you look at how the basket of media stocks have traded this year, it has been quite volatile. There's been a real lack of interest as the stocks in the media basket had declined quite rapidly. And then there's been some buying back on different news flow. You've actually seen a little bit of interest come back into the equation. So what this consolidation does for the broader sector this morning could be somewhat fascinating.
Yeah, and I think it's sort of very it's a very telling sort of temperature check on the situation in the industry, where traditional viewing of linear TV is losing ground to streaming services, particularly when it comes to the entertainment sphere. And in order to survive and navigate that, we have had talk of this consolidation, this deal, rumours between Sky and ITV for some time. Recent headlines include Sky pledging £2 billion to ensure that some viewer favourite shows will continue after the takeover. But of course, any sort of deal like this will raise questions about which bits they see as profitable, which bits they see as worth investing in, and which bits they see as worth keeping. Because, of course, the ripple effect through to the wider sector and the jobs market the industry, has come under pressure. People working there, particularly freelancers, talk about the pressures they face now in the industry as things have been cut back.
Something that hasn't been said. We've been talking at length about the amount of services we're all signed up to, and there was a view that we would take a rational approach to some of those subscriptions. That's kind of been coming through. There's been a cost of living crisis that has morphed from one to the next over the years. So I think people have taken a rational approach to their streaming services, subscriptions. But there's another big subscription around the corner. That's AI. I mean, how many AI subscriptions are we required to have now? You're getting the first approach where you can, use ChatGPT. You start to bump up against a firewall. Same with Perplexity. You start to bump up against some sort of you need to pay for subscription services beyond that. So there is another subscriber universe coming. And what impact that has on the content subscriptions will be fascinating from here. But you've already got an industry that is moving aggressively, I think.
Yeah, and I think what you point to there is a really valid point, because you have a situation where the disruptors potentially then become the disrupted. The streaming services that shook things up then find themselves, as you say, feeling the ripple effects, the downstream effects, the fallout of people putting a bit of their money aside to pay for the AI services that they've become so used to having for free up until that point.
It's a great way of putting it, because the life cycle of a disruptor is that you do get disrupted at some point too. Let's push on to what we've got out of the Asian markets. It is a huge week for semiconductors, and this is the epicenter for some of those memory chip plays. Watching very closely the likes of Samsung, as it reports later this week, and SK Hynix, that has been chasing a listing through the United States. So this is the picture. Japanese stocks are down along with the South Korean market. Retreat for those two tech-heavy plays. The reversal there matched by some green moving on to the Hong Kong market. Also around Shanghai, up 0.2%. So real mixed trade across on those Asian markets. Don't forget Wall Street was shut for the 4th of July holiday. Independence Day, the Friday trade was not part of the picture, so a lack of direction too as we get going for the Monday session. European markets on the back of that, as we saw Friday, there was still some momentum that came through, particularly around German stocks. We climbed about 0.75%. This morning, more tentative again, perhaps that lack of direction that we've got from the US plays. But so far, the 50, stocks 50, are called a little bit weaker, and across the board, we've got some geopolitics on the cards this week, NATO meetings. So we're looking to see what impact that too has in terms of market psychology. I want to take you to US futures, the early picture stateside. This is the early glimpse that we're getting. Does seem to be inclined higher, and tech plays in particular in focus. I mentioned the earnings roster that we're going to get thanks to Samsung. Markets last week very bumpy again around the semiconductor plays. Some fairly strong moves just in session before we wrapped up that Thursday trade. We were down 4.5% on the VanEck semiconductor, so clearly looking for some direction on the earnings there. Let's get to Matthias Heim, who is the CIO at Bell Capital. Matthias, thank you so much for joining us today.
Great to be with you.
We're just trying to set the scene around semiconductors. I feel like we are seeing the market incredibly bumpy and volatile around the semiconductor trade. They're worried about CapEx, they're worried about the Federal Reserve, what central banks may be doing, and they're worried about how long the cycle is in terms of ordering for some of these high bandwidth memory chip plays. What do you think the significance is of what we're going to hear this week?
Well, I don't think the rate decision or the central banks have a lot to say in this market trajectory. I do think it's very fundamentally driven. But the one thing I want to highlight is if you look just back past 1 year, there's been a big divergence in what you would call the AI capex beneficiaries as a whole, which have been great performers. On the other hand, the hyperscalers, the ones spending the money, have been quite lackluster, and I do think that picture tells you there's been some economic leakage being priced in, because in the end, economics have been very strong at the receiving end of investments, not so strong at the spending end. And that might imply that there is some worries around how strong that trajectory will be, or whether we will see going into the next 1 or 2 earnings season some wording which points towards at least a peak in the growth rates of these capex investments.
It's somewhat rational to see investors take that approach, that they think that there are some risks they priced in where they priced in. The fact it's actually baked into some expectations is welcome, because it does push back against the narrative of bubble-like territory across on markets. What the question I think is left now for investors is whether some of that lackluster appetite, fear factor creeps into the semiconductor space where it hasn't been so far. Do you think that's what we're watching with these extreme moves, or is that just leverage?
Well, I don't think yet. I do think the fundamentals still intact. The one thing which I think is a bit worrying is that the massive derating we've seen with the hyperscalers, they're now trading at the relative price to book ratio versus the overall market, actually lower than the trough of 2022 post the big interest rate cycle. And I do think that derating could be unsettling at some point. And let's be very frank.
Sorry, derating unsettling in what sense? You think it carries across to the broader market?
Yeah, exactly. Because in the end, there needs to be profitability at the spending end. These hyperscalers need to have a quite decent return on investment, otherwise there will be a slowdown. And I do think that's sort of somewhat creeping into markets. I don't think it's necessarily very frightening yet, but it's something to watch, yeah, clearly.
Matthias, in terms of where we are with the inflation picture, oil prices have come down. They're not far off their pre-war levels. The jobs print for the US was much lower than expected.
Right.
Those fears around a rate hike seem to be dissipating slightly. What's your take on it and the positioning investors should be moving towards in light of these latest changes?
Yeah. So, in my opinion, oil prices never were that scary in the first place, because oil doesn't matter that much anymore for the overall economy. It was always very contained towards the energy space, also the inflation push we have seen on headline. So I don't think there's necessarily a fear, or never was really a fear, that we're going into a prolonged rate hiking cycle which could then derail the equity market picture. Because let's be very clear, inflation as such, slightly higher inflation, is never a problem for equity investors. It becomes a problem once this inflation is start to be sort of attacked by central banks by raising interest rates in a prolonged fashion. But that's not necessarily the picture here. We do see the current relief on oil prices as very welcomed. We think that disruption is fading away. A lot of the Asian economies will fare better. A lot of other oil importing countries will fare slightly better. So we do think we're at actually probably the trough in economic growth, and economic growth should rebound slightly from here. Same goes for the US, where we have seen quite a contraction in real wages simply because headline inflation surged and the wage growth was quite steady. We do think that's going to reverse into year end, and so the consumer actually now feels quite bad. Consumer sentiment is trough, but that should actually improve as we move into the back end of the year and into next year.
And then in terms of the sort of the coming quarter, coming half of the year, where do you see the sort of opportunities lie? Because we've had such a strong earnings season, and you know, that has in some cases pushed valuations quite high. People may have feel they've missed the boat on some of those opportunities. Where are the opportunities to come? Yeah,
sure. We think there is a big opportunity still to broaden out your equity exposure. So far, a lot of the strong gains have been AI related, CapEx beneficiary related. But then again, look back just 1 year or year to date, regional banks or just US financials in some part have been very strong. And that is sort of the underlying confirmation that we could see a broadening out of economic activity. So we still like US financial being on the banking side, be it on insurance brokerage, specialty insurance. We think there's plenty of opportunities there, which are, by the way, nowhere near as pricey as some of the areas where the margins have been rising for quite some time.
And then in terms of what we heard from the central bankers in Sintra, what was your take on the outcomes of that?
Well, I think there's some cautious talk around inflation, which I do understand. I do think the current picture is actually fairly balanced. We think inflation as a whole is not a big concern. Actually, Europe, we assess the picture slightly different. We think when we do have a growth problem, we don't have so much of an inflation problem. So the policy mix at the moment is not that favorable in Europe. So rising interest rates in an already weak growth environment, that's probably not the best policy mix. So we therefore have still the US as the main equity market for us, and also for the foreseeable future.
Just to your point around that, though, it looks from the Europeans' perspective, you start charting what happened over the past week, that some of those diversified trades came on into Europe, and they went back to some of the usual areas. You saw it in the banks, you saw it in some of the industrials, chemicals actually bounced as well, autos was left behind. But there isn't a feature there where the DAX is now on the front foot, it seems. FTSE's picked up and broken out of a range.
Right.
Do you think this has got further room to run purely based on the diversifier theme?
Well, to some degree, but in the end, we're in an earnings-driven market. In the end, earnings growth will define what's going to perform over the next 12 to 24 months. And there, just one big element which is still lacking in Europe is the deregulation push, which we see in the United States. take financials, for instance. I mean, the deregulation happening on financials in the US will probably free up quite some capital, allow for more lending or share buybacks in an accelerated fashion. We don't see that coming through in Europe yet. So, US clearly in a better position, I would say.
Okay, Matthias, really good to have you with us. Thank you for kicking off the look at the markets this coming week. Matthias Heim, CIO of Bell Capital. Coming up on the show, political intrigue dominates the conversation in Aix-en-Provence ahead of a court ruling on whether Marine Le Pen can run in next year's presidential election. Plus, Iran and Greenland threaten to overshadow a crucial NATO summit. And as US markets get set to reopen after a long weekend, we'll get you set up for the week with Raymond James Investment Management's Chief Market Strategist, Matt Alden. All of that still to come on the show.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back. Inflation is already in the system. That is the warning from ECB Governing Council member and Central Bank of Ireland Governor Gabriel Makhlouf, who told CNBC that price pressures are not going to disappear despite the recent slump in crude prices. Speaking to Charlotte, Makhlouf advised caution on developments in the Iran conflict.
We should just be careful about reading announcements of the end of the war or announcements of, deals. We should just wait to see what actually happens. So certainly the fact that oil prices have gone down is a positive thing. But we know our June decision, where we raised rates, we know inflation is already in the system. And the fact that oil prices have fallen doesn't mean that inflation is going to disappear. So we need to continue to keep a very close eye on what's happening.
A Paris appeal court will tomorrow decide whether Marine Le Pen, leader of the National Rally Party in France, can run in next year's presidential election. Le Pen, who's currently topping opinion polls, was convicted in 2025 on embezzlement charges and barred from holding public office for 5 years. The appeals court will decide whether to uphold the conviction. If it is upheld, Le Pen has pledged to support her protégé, Jordan Bardella, in next year's presidential race. Well, the vote next year was top of the agenda in Aix-en-Provence over the weekend, with several potential candidates appearing at the economic conference. Also appearing at the conference, our very own Charlotte, and she's back and joins us now. So many conversations we heard you having there, and so much for them to get their teeth into.
Yes, and certainly it looked like the French presidential election was very much top of mind. All the potential presidential were really attending the conference. It really shows that the campaign is on. We will only find out who the next president is on May 2nd next year, but certainly it looks like they're all throwing their names in the ring, whether it was François Hollande, the ex-president, Bruno Retailleau, the ex-interior minister, Gabriel and Edouard Philippe, two former prime ministers of Emmanuel Macron. They were all there, including, we heard, the prime minister, Sébastien Lecornu, potentially kind of indicated they might throw his name, and Christine Lagarde saying that she's keeping an eye on the domestic situation and that, she's not ruling out potentially ending her mandate at ECB earlier than expected. So, it's all up for grabs. And that's because, of course, Emmanuel Macron cannot run in another election, and it's not clear who might be the heir, while the far right, of course, is leading in the polls. Here again, we don't know who might be running because of what you were talking about, the appeal court decision tomorrow. So it's all up there. Certainly one other person that has thrown his name in the race is Dominique de Villepin, who was prime minister between 2000 2005 and 2007 under President Chirac. He faced some huge protests at the time because he tried to put in place some reforms around some employment laws, certainly some echoes to Emmanuel Macron. He was also Foreign Affairs Minister during the Iraq War, so he stepped away from politics for around 20 years and came back just last year, forming his own government called La France Humaniste. So when I had a chance to catch up with Dominique de Villepin in Aix, I asked him whether his comeback to politics had anything to do with the big election next year.
It has a lot to do with the elections and the difficulties we are facing. France is currently facing many challenges and we need to get ready. That means not only to have a project but also to have a party organization in order to compete in those next elections. And I think that the challenge is very high because the risk we are facing in France is to have the Rassemblement National being in a position to win the next elections, and for the first time in our history. And that will be, of course, very damaging for France, but also for the European Union, because it will send a very bad signal for all the liberal democracies in the continent.
One of the reasons the far right is in the lead in the polls, of course, there's a rise of populism globally, but there's also the French political fragmentation. And you decided to create your own party rather than rejoin your old political family. Do you think this fragmentation is dangerous and here to stay in France? It has created a lot of instability. Is it here to stay?
Well, I think we are facing two different types of risks. The first one is polarization. And we have the far right and the far left who are quite high. Of course, the far right is very much dominating the game. But the far left is also quite strong, above 50%. So the question is, how are we going to be able to unite the rest of the different parties? And for that, we need to have some kind of a competition of ideas. Currently, we cannot compete without having a strong vision of the changes that need to be done. And of course, many current leaders in the bloc central, what we call the bloc central, are coming from the Macronist party. They are the heirs of this political party. So we need to rejuvenate the game and the party, and that's why we are coming with new ideas in order to transform the perspective. But at the end, you are right. At the end, we need to have some kind of a unity to confront with the Rassemblement National and La France Insoumise.
And I assume you think you're potentially the man that can unite all these blocs in the middle?
The question is where to stand the best to be able to unite all the different groups. I think many do think that standing very strongly at the right may be the best position. I believe that you need to, if you want to assemble, you need to have a position where you can be listened from the left as well as from the right. When General de Gaulle, at the end of the Second World War, wanted to reunite, he did not ask the people to join him and to forget about their own ideas. But everyone was coming as it was, as a communist, as a liberal, as a Christian Democrat. So whoever wants to join needs to join, not forgetting his own ideas.
That was former Prime Minister Dominique de Villepin speaking to me about the next presidential election. He might be one of the names in the run there. Of course, all the conversations in Aix were also about European competitiveness and sovereignty. And I had a chance to catch up with Stéphane Séjourné, the Executive Vice President of the European Commission, while in Aix. Of course, he has been working since the beginning of the year on the Industrial Accelerator Act. It was proposed back in March 26. That aims to boost the industrial manufacturing in Europe to around 20% of EU GDP by 2035 from around 14% currently. And so there's some controversial elements to this piece of legislation, including the Made in Europe element to it, which means that some parts have to be made in Europe in some key technologies, including renewables, batteries and cars, to benefit from government subsidies, as well as from some European procurement elements as well. So some are worried that it might be too protectionist. Others said this is a pragmatic approach. So when I sat down with Stéphane Séjourné, I asked him whether he was surprised that this piece of legislation was so controversial.
Oui, c'est à la fois difficile parce que c'est un changement de doctrine.
Yes, it is challenging because it represents a shift in doctrine. First, but at the same time, it's highly anticipated by many economic players. The proof lies in the fact that here in X, a large part of the business community is eagerly awaiting this legislation and even wants to expand its scope to cover several sectors of the European economy. So we have at the same time some political reluctance, but that attitude is gradually shifting across Europe. I believe value chains are being disrupted all over the world and we must respond as Europeans. And there's great expectations from the business world.
And yet we've heard some critics saying that yes, it is a paradigm shift, certainly, in principle, but it's a paper tiger in practice, this legislation. What do you say to that?
Moi, je pense qu'en pratique, il faut être pragmatique.
I believe we need to be pragmatic. We have sectors facing unfair competition and we're dealing with American tariffs, which we didn't want. Each sought to defend their own economy by re-industrialising. Europe's re-industrialisation will also depend on defending its economy in strategic sectors, such as clean tech, automotive and construction, as well as parts of the chemical industry, which is the industry of industries in Europe. In short, regarding all these sectors, we must be pragmatic and also consider the international landscape.
And on this question of unfair competition, we know we saw this joint communique between the EU and China recently, the first one in many years, reopening talks to try to rebalance the trade relations. And yet it looks like a battle is looming with China very soon. How do you position yourself in a strong position against China?
Je pense que d'abord, il y a un sujet de méthode et de crédibilité des Européens.
First, there's the matter of method and credibility from the Europeans. We must stand united and be able to use our trade defence instruments to establish that credibility. So for now, Europe needs to demonstrate that it's prepared to close its market when fair competitive conditions are not met.
L'Europe est prête à permettre justement.
Europe is prepared to allow the use, notably at the Commission, of tougher trade defence tools. And so we're currently working internally at the European level to have that credibility. In a second time, we will need to reach an agreement that balances trade, and so we need probably some level of interdependence. But today there's such an asymmetry in our dependence on China that it's no longer sustainable for the European economy.
Of course, some critics of this Industrial Accelerator Act, they said that will create some extra red tape at a time when there's some calls from deregulation. So this Made in Europe element is adding some red tape. Also argue, the elements like forcing some foreign investors into joint ventures and some intellectual property transfer. That this is, very, very much putting some hurdles into investment into Europe. So, there are discussions that are continuing. The consultation is ongoing on this, and trying to get different countries on board. We know Germany is a little bit more reluctant with it. So waiting to see what that means. But here again, really interesting to hear on the upcoming battle how Europe is a question of being credible when they're putting their stance and ready to use some tools against China if necessary. So it's not protectionism, it is very much pragmatism that the Europe needs to do what the US and China are doing as well. So really interesting to hear there from the executive representative of the European Commission from X, where all the talks was about European strategic autonomy and sovereignty as well.
That is fascinating, the interpretation, because there is a view in the States and in China when homegrown talent are pushed forward. That is positive for scoring home goals. But here we're talking about it just being another layer of regulation that companies see as another negative when these companies are pushed forward.